Good afternoon, everyone, and welcome to Henwood Court's investment webinar, Weathering the Storm. Today should take approximately 1 hour. Apologies if we may run over, but the intention is to certainly be completed within the hour. Thank you for joining us today. Some of the information we'll be going through today will be a refresher for a lot of you, but equally there'll be some new stuff in here, particularly reviewing performance and trying to look at what's going to have in the future. We've had the Henwood Court crystal ball out, which of course never lies. So the purpose of this presentation is to provide you with an overview of Henwood Court's investment philosophies, strategies, and of course performance. We're also going to be looking at the performance, particularly since the onset of COVID-19 and when the markets fell in February, on 20th of February. Our purpose is very much built on establishing long-term relationships with clients in order to help them maximize the probability of achieving their goals for reasons that are important to them. Along the way, we can help each of our clients get their entire financial house in order so they can relax with the knowledge that everything is in its proper place and under control. Making this happen in the real world requires a committed and knowledgeable team, and very importantly, a dependable investment strategy. We always try to stress to our clients, however, that money is a tool that should be used to provide more life, not a commodity to be amassed for the sake of it. What's ultimately more valuable in life is time, and arranging your life in a way that gives you adequate money and spare time to enjoy doing the things that are important to you is a challenge that we recommend you all consider. So if we could move on to the next slide, please, Peter. I think it's a great way to kick off, really, and to quote perhaps the most renowned and certainly most successful active manager in Warren Buffett, who said, "To invest successfully over a lifetime does not require a stratospheric IQ, unusual business insights, or inside information. What's needed is a sound intellectual framework for making decisions and the ability to keep emotions from corroding that framework." And I think that just sums up everything about our investment strategy. That the media would have you believe that successful investment experience comes from picking stocks, timing your entry and exit points, and making accurate predictions and outguessing the markets. We at Henwood Court think there's a better way. It's true that some people do get lucky making bets on certain stocks and sectors. We've all heard stories of people coming out the markets in February before the fall, getting in and out at the right time, or correctly guessing market movements in interest rates or currencies is a real tough game. And we feel pinning your hopes on luck is simply not a sustainable strategy. We feel that's speculating, not investing. Our alternative approach to investing through Portfolio Sense doesn't sound as exciting, but it's far more disciplined and increases your chance of a successful outcome, which is ultimately what we're looking to achieve for our clients. Portfolio Sense essentially means removing the influence of fortune as far as possible, taking a long-term view and considering your own needs and appetite. Of course, risk can never be completely eliminated, and there's no guarantees about anything in life, but you can increase your chances of a successful investment experience if you follow the principles and practicalities we're going to be covering today. I always love this quote again from Benjamin Graham, who said, "People don't need extraordinary insight or intelligence. What they need is a character to adopt simple rules and stick to them." And that's certainly what we try to achieve with Henwood Court, with Portfolio Sense. Next slide, please, Peter. So let me just explain that Portfolio Sense is an investment theory that's used and followed by many advisors and thousands of investors across the UK and the developed world. It's a strategy that we adopted 10 years ago, over 10 years ago. And I'd just like to point out that we are independent financial advisors with access to active managers, both household and niche discretionary funds. However, we choose not to use such providers because the evidence proves they offer no premium return, but often come at a premium cost. We can't control the markets, but we can control costs, and we can implement strategies that are designed to optimize the returns with access to sectors that deliver long-term outperformance within a hugely diversified portfolio. It is a dependable investment strategy that we feel will win the loser's game. It very simply does what it says on the tin. Next slide, please, Peter. Okay, so the contents of today is I'm going to look at the principles that underline the theory behind Portfolio Sense. Then Paul Bradley, our investment manager, who many of you will know, will look at the practicalities behind implementing Portfolio Sense. And Paul will also look at the performance of Portfolio Sense over a reasonable historic period, and also since the onset of COVID-19. So we can have a good look at what's happened to your assets over that period. And then I've got the job of predicting what's going to happen. As you can imagine, I'm going to look at a range of scenarios and what you can potentially do about it. There will be the opportunity to ask questions, but we will deal with these at the end if you don't mind. And there is a Q&A tab where you can ask your questions, or you can use the chat facility. We will be looking at these at the end of the webinar, and answering these. Okay, so let's move on to the next slide, where I'll look at the principles, the theory behind Portfolio Sense. And the next slide again, please, Peter. Okay, so 6 sensible rules that we look at following, and these are behind Portfolio Sense. Firstly, to invest on purpose. Maximize your return by investing in equities, investing long-term, retaining some cash, keeping emotions in check, and tracking the markets, not picking the market. So let's look at these in a bit more detail. And again, if we have the next slide, please. We believe in the principle of investing on purpose. So what do I mean by that? It means simply knowing and understanding the investment return you need to achieve your objectives, whatever they are. So any sensible investment conversation should start with a detailed discussion about what's the purpose of your money. So before any client's money is invested, we take time to consider their goals, circumstances through our Financial Sense program. This initial planning, in my opinion, is absolutely essential for a successful investment experience and starts the foundations for an investment plan. Diving straight into considering investments prior to considering what the purpose of your money is, in my view, is a kamikaze approach, and indeed could be costly. So you need to be asking yourselves, why am I investing? What's the purpose of this money? Ultimately, we want to build a strategy that will give you the target return, which is the return you need to achieve your objectives and goals you outlined in your financial plan. And it's very common for people to have a range of goals over different timescales, and therefore having several different elements within a portfolio. So cash would be a suitable home for monies that will be spent in the next few years, and you may have a more aggressive strategy with more equities in a portfolio for longer term goals. So the key message we give is, if you are planning to invest, don't invest in planning first. So you can invest on purpose, understanding the exact return you need, so you can base your portfolio construction on this. Next slide, please, Peter. When we're investing on purpose, we then want to identify the risk required. So if we've identified your target return, it would be wrong to simply then place monies into investments intended to generate this return without firstly measuring your capacity for risk. But again, statistical evidence demonstrates that the more market risk you take, the higher investment return you will achieve over the longer term. And this is known as the risk premium. The chart you can see on your screen there is a capital asset pricing model that was developed by a Nobel Prize winning academic, William Sharpe. And it basically states that investors get rewarded for the more market risk that they take on. And indeed, historical long-term evidence has proven that the risk premium associated with equities does exist, and the greater proportion of equities within a portfolio the higher the longer term returns. The question really for the investor is whether they're able to financially and emotionally cope with the significant short-term fluctuations that they will experience when you hold a high equity content portfolio. So part of our process is to identify and understand an investor's capacity for short-term losses and investment volatility. While we can do a lot to mitigate risks, we can't eliminate it as we're experiencing it today. In any investment plan, therefore, you have to understand the amount of risk that you're taking and to be sure that you're comfortable with it. This will greatly increase your ability to adhere to a long-term investment plan and increase your chances of achieving your financial goals. We break the risk equation into three parts. Firstly, emotional capacity for risk. So this is basically how you behave when the markets fall, as they have done over recent weeks. You know, of course, you know, over the period of investment, the value of the portfolio is going to rise and fall, and prudent investors are aware of this. And equity markets are particularly very volatile, and investors must expect that there will be regular periods of rising prices and falling prices. So your risk tolerance really defines your level of comfort in coping with market downturns and your ability to stay the course. If you take a risk that's within your risk tolerance, then you're more likely to maintain your investment strategy through weak markets as we're experiencing today, as well as strong. And this gives you the best chance of investment success. If you can't tolerate the downsides associated with a risk that you're taking emotionally, then you won't stay the course and you'll get out at precisely the wrong time. So it's really important we have an understanding of that. Secondly, financial capacity for risk as well. You know, our clients will appreciate that we do at regular review meetings. We look at their financial plans, the impact on their unencumbered assets, the bucket as it's more frequently known, on market downturns. So we regularly model this. And it's so important that when you take an investment strategy, you are able to withstand financial losses, because total dependency of your portfolio may result in electing to have a reduced level of risk. So measuring that financial capacity is vital. And finally, of course, looking at the target return. Again, this starts with the return you need each year, and then consider how much risk you need to take to achieve that. If you don't have the emotional financial capacity to take the level of risk required to achieve this target return, then you may need to reduce your expectations of return, which may result in you having to reduce the lifestyle that you can enjoy. Equally, if your target return is lower than your emotional and financial risk capacity and tolerances, and you have other resources, then of course you may wish to take higher risks with the knowledge that over the longer term, you'll get a higher return. Okay, if we could move on to the next slide, please, Peter. So the second principle that we follow is maximize your return by investing in equities. And again, as this chart does demonstrate, equities have outperformed bonds and indeed cash, which is the red line. Bonds is the blue line, equities is the green line, over a sustained period of time. So I love equities, and you know, they've served our clients well, you know, across almost 25 years of me giving advice. So long-term returns from equities are greater than bonds and cash because you get compensated for taking that level of risk. And while I'm obliged, of course, to tell you that past performance is no guide to the future, I believe over the longer term, the past is a good mirror of the future. And we should take it as a given that equities are likely to continue to outperform cash and bonds. Speaking of givens, here's another one. There's no free lunch, and past and recent performance tells us there will be setbacks and sometimes substantial ones, but these are generally short term. So if we accept the idea that equities will outperform bonds and cash, what's the catch? Well, we know what the catch is, and it's the falling values, commonly known as risk. But risk is in price. Risk is really just volatility, which is temporary. So in a suitably diverse portfolio, the only way to turn in a fall in the markets into a permanent loss is withdrawing at the point when the markets have fallen, either due to poor advanced planning, fear, or panic. Next slide, please, Peter. Many of you will be familiar with this chart that's on the table now, and we all should be thinking of a long-term investment strategy, and I'll come on to this in a moment. But if we want our investments and our incomes to maintain pace with inflation, then we need to be investing in equities. And Nick Murray, a US financial guru, said, in the long run, it's stocks that are safe and bonds that are risky. Let me repeat that. In the long run, it's stocks that are safe and bonds that are risky. And that's because the effects of inflation will have a devastating impact on your purchasing power. And the best defense against inflation and rising prices is an investment that has the potential to provide above inflationary long-term returns. So the risk of holding equities for the long-term investor is wildly exaggerated and confused often with volatility, while the long-term risks are near non-existent. And that's been true if you look at the historic returns of equities. The long-term risk of equities are near non-existence. And investors totally underestimate the long-term risks of not holding equities. And this chart really demonstrates this point, and the associated principle, high short-term risk of holding equities, of course, but how this risk is reduced to nothing over time. However, the reverse is true, of course, for the purchasing power and cash, where inflation risks are increased over time. Next slide, please, Peter. So again, anyone that invests with us invests for the long term, and the long term is possibly for life. Obviously, that doesn't mean you're not going to be drawing out of your portfolio. You will, of course. It's there to provide for the lifestyle that you want. But one of the many surprising facts about investing is that having a long-term horizon is a powerful advantage, given the impact of compounded returns and the risk reduction factors over time that we've just looked at. So you want your investment horizon to be as long as possible, because as an investor, time is your biggest ally. Furthermore, there's no magic wand in the field of investing, yet many investors still believe, perhaps due to the noise that comes from the city and media, is that there are active managers who can predict the future, anticipate market movements, and select the next top performing stocks, which allows them to deliver outperformance. Maybe 30 years ago, this could have been achieved, but in today's efficient markets, it's less likely. The overwhelming evidence demonstrated by study after study is that this certainly isn't the case, and indeed it's a futile and costly exercise. The good news, however, is that you don't need a crystal ball to enjoy a good investment experience. And as Paul will show a bit later, the overwhelming evidence proves that by adopting a buy and hold strategy, which ensures investors' emotions do not participate wealth destroying buy high, sell low behavior, will deliver a long-term successful investment experience. So the analogy I always use, if you were going to plant a tree in your garden, you wouldn't dig it up every year to see how the roots are doing. And if you're not happy, move it to another part of your garden. Investing is no different. You just need to invest your money, leave it alone, and let it flourish. Of course, it's important to position the portfolio right at outset, but then you effectively get rewarded by being lazy. Again, back to Warren Buffett, he had a great quote, and he said, the hallmark of our investment process is benign neglect. And again, I think that's so true with your own investment strategies. Set them up correctly, leave them alone, and let them flourish. Next slide, please, Peter. Cash is king. What do I mean by this? Cash. Cash is what you keep available for you to cover your short-term expenditure. It is a drag on returns, of course, the long term, so you shouldn't have too much in cash. But behind every investment and successful long-term investment strategy, people have cash to cover short-term commitments. It's what we call a cushion for caution, and it's kept separate from your long-term investment portfolio. This will allow you, cash will allow you to sustain a long-term investment strategy without having to draw down on funds and avoiding distressed sales like could potentially happen today when markets have fallen. Cash means you don't have to panic and have the capacity to cope with the volatility that we're seeing at the moment, and it reduces the short-term risks of equity investments, allowing you to share the long-term benefits of investments. If cash reserves are low, they should be topped up via portfolio withdrawals at a time to suit you and your portfolio. And obviously that time isn't today unless we're taking money out of bonds. And that process just keeps repeating itself. And obviously the amount of cash you need is determined by a number of factors. Whether you've got surplus income and accumulating money, then you don't need your cash reserves to be as high. But if your expenditure exceeds your income, then your levels of cash will potentially be higher, particularly if you have some short-term expenditure in the next 1 to 3 years. Next slide, please, Peter. One of the key areas for us as principals is keeping emotions in check. This is absolutely crucial for our clients. The crucial question for us is not whether your long-term return on equities will exceed bonds or cash. I think we've demonstrated evidence of that will, but it's whether you, the investor, will not sell at the wrong time. The problem's not the markets, but it's us as investors with our perceptions and our all too human reactions to these perceptions of the markets. So investing is often likened to riding on a roller coaster. And if you consider the typical behavior of the vast majority of investors, as we see in the media, you can understand why. As the diagram shows here on the screen, when there's an upward trend starts to emerge, either for an individual stock or for the market as a whole, the investor follows the herd, follows the trend, but only buys once he or she is convinced that it's for real. Unfortunately, this is usually at the point that all the gains have been taken when the trend reverses. And you can see the emotions driving investors are a powerful force that leads them to buy high. And you can also see from the diagram on the screen, a similar set of emotions, although in reverse, come into play when the stock markets fall, causing investors to sell low. This is the classic greed and fear roller coaster that destroys wealth. Next slide, please, Peter. And again, this graph illustrates world stock markets are resilient. There is not one crisis that we've not recovered from. Let me repeat that. There is not one crisis that we've not recovered from. And we'll demonstrate this later when looking at some predictions. So it's inevitable at some point we're going to get market crashes and the investment values will fall or plunge in value as world events, many of them are political or economic, cause this. But again, we should accept this as investors as the norm. And I'm with legendary investor Sir John Templeton, and many of my clients will have heard me have said this before. And he said, the 4 most dangerous worlds in investing are, this time it's different. So that chart there just demonstrates the amount of crises that the markets have recovered from in the past. Next slide, please, Peter. And again, this slide here really demonstrates the importance of not trying to time the market. So this slide shows the impact if you came out of the market at the last slump on the 1st of November 2008. During the eye of the credit crisis storm, imagine someone selling on the 1st of November 2008 for 1 year, and they were invested in a portfolio of 60, which has got 60% equities, 40% defensive holdings. So coming out and holding in cash for 1 year, the red line demonstrates the impact of that occurring. And again, the green line shows the difference in performance. So we would advise against trying to time the markets. We feel this is a loser's game and we don't want our clients to be losers. So our job at Henwood Court is not only to create better investments, but also to create better investors. Next slide, please, Peter. Finally, final principle is for us is track, don't trade. Again, just to stress, we have access to the whole of the market. We do not have to adopt the approach of portfolio sense, but we choose to because we unearthed an overwhelming evidence in favour of using index approach to investing. And the decision about whether to employ an index or an active approach revolves around 3 key questions. Do the market exhibit inefficiencies that managers can use to their advantage? Can these inefficiencies be profitably exploited after costs, including taxes? And can skillful managers be distinguished from lucky managers in advance? We believe the answer to all of these is no. The inability of the majority of active equity managers to consistently outperform the benchmark index over the longer term in both efficient and efficient markets after cost is broadly documented. There's been countless studies of active managers' performance consistently suggesting that previous good performance is at best a weak and unreliable predictor of future performance. And where it has occurred, it's only in the short term. Additional findings also indicate that bad past performance sometimes persists, and in many cases is just due to high costs. So the overwhelming evidence does demonstrate that tracking indices rather than using active managers to select fund managers that is an expensive game favours the index approach. For us, it's asset class selection that drives return, not the fund manager. Next slide, please, Peter. So just to conclude the principal side of things, as the slide shows here, studies have demonstrated that benchmark indices outperform the vast majority of active professional managers, and professional managers themselves outperform DIY investors. DIY investors, of course, lack accurate information and often the time to make good investment decisions. They are also often driven by emotion and as a result lack discipline and frequently act on impulse. This drives down their return and is the reason why they are outperformed by the professional managers whose living depends on understanding the markets and making tactical decisions. However, beating the market has proven notoriously difficult for the vast majority of managers, and those that do, these profits are often depleted by high costs, and many don't do it for long. They don't outperform for long. It's largely a result of luck rather than judgment, making it impossible for people like me to select these good managers in advance. So as a result, from our perspective, just tracking an index is better. But of course, Portfolio Sense tracks many indices, and through holding assets that are the drivers of return and keeping costs low, regular rebalancing, our objective through the practicalities Paul's going to show you now is to give you the market return plus some. Okay, I'm going to hand over to Paul now, who will talk about the practicalities of putting our portfolios together. Paul.
Thank you, Nick, and good afternoon, ladies and gentlemen. Nick's asked me to talk about the practicalities of the investment and how this helps our clients achieve not only market but market plus returns. Ultimately, our aim is to construct a strategy built upon academically researched and evidence-based principles which an investor can be comfortable to hold through both good and bad times. Next slide, please, Peter. To do this, there are three elements that we approach. Firstly, there's the research behind that. We use information on current market prices, fundamental data to identify differences in expected returns among different types of securities. Using that, we look at the product design, building in the asset allocation to which Nick's already referred, diversification, the interaction of asset classes, the premium of returns that we can obtain, and ultimately trying to look to obtain these at low cost. And finally, it's thereafter the management and trading, looking here at rebalancing processes and the application of discipline to ensure that we're not eroding our own wealth. Next slide, please, Peter. Of course, there are a number of assumptions that we need to make. And I think, again, as Nick's alluded to on a number of occasions, one of the greatest influences on the performance you're expected to achieve is that based around the asset allocation, the interaction between different stocks or different stock types, rather than the attempts to time markets or select specific types of stocks. I quote up the most recognized study here, although there have been a number of studies over the years, all demonstrating that the asset allocation has a greater than 90% impact upon the performance of your portfolio. Ultimately, this should enable the investor to have a portfolio that they are comfortable to hold during both good and bad market periods. Next, please, Peter. In effect, we make the assumption that markets are efficient. In today's environment, with a number of analysts and the speed of technology, pretty much everything is known about every stock instantaneously. Consequently, given all this information, a stock's current price reflects the aggregate expectation about risk and return, and therefore we make that assumption that it is accurate. Now, of course, this is purely an assumption and will not necessarily always be the case, particularly when taking into account human emotion. Next, please, Peter. Again, as Nick mentioned, there's a world of opportunities in investing in equities. Being in the market will give you a great return. However, how do you know which market to select? Now, as demonstrated in the chart here, there is no pattern to identifying which market will perform well and when that will be the case. For example, as illustrated by emerging markets, one year you could be down by almost 10%, as in 2015 here, and the following year up by over 33%. Consequently, you do not look to select, you look to obtain exposure to all. I know Nick mentioned earlier, there's no free lunch in life. There might be a slight contradiction to that, but diversification is often being regarded as adding value. So it actually is often regarded as the only free lunch in all of investing. Next slide, please, Peter. So, accepting that holding the markets will give you great returns, how do we look to achieve better returns than that? Well, ultimately, risk and reward are absolutely related. And the only way to consistently increase the reward is to take a greater amount of risk. This is done by including additional weightings or tilts into recognized drivers of return, such drivers being company size. So we would err towards smaller companies, those at the bottom end of the market by size, who have to offer a greater return in order to attract investors. Why would you invest in a small company unless there was a benefit from doing so? Similarly, value as opposed to growth companies, value being a company that's out of favor, its share price being undervalued, generically, typically due to sentiment rather than actual fundamental activity. In effect, you're then buying the stock at low cost, which give you the greater opportunity to receive enhanced returns. Next slide, please, Peter. And ultimately, this is absolutely demonstrated by this chart, which shows that small and value have outperformed the market as a whole, which in turn has outperformed fixed interest or bonds and inflation. Next slide, please. Again, we do recognize that these premiums aren't consistent. They're not always there. If they were, it'd be so straightforward to spot these. We do know that they are cyclical in nature. What we point out here is the regularity of how often small cap outperforms large cap and the extent of it doing so. As you'll note from the red bars, there are periods of time where large has outperformed small, but this is something we accept, something we recognize will always be the case as sentiment drives markets and the cycles take place. Next slide again, please. And similarly, value has also seen cycles within its performance. And unfortunately, at the moment in time, we are going through a less positive cycle at this stage. In effect, there are a number of factors that impact upon this, and indeed, as illustrated by the next slide, what we actually identify is that the value premium itself hasn't really disappeared. What I'm illustrating here is that the annualized returns over the longer term for the value index on the left aren't that different over the last 10 years from that we'd expect normally. What has changed, however, is that a number of growth stocks have been causing a growth markets to significantly outperform. And a lot of this has been down to the influence of the emergence of the FANG stocks, Amazon, Netflix, Facebook, Google, for example. And this has been a big impact upon the markets at this stage. Obviously, we don't know how long this influence will retain. We could also link back to the dot-com falls of the early part of the century, very much built around these style of companies. But of course, recognizing that we also hold the whole market in our portfolios, we too have exposure to these stocks. So even though we're not seeing that premium at the moment, the fundamental of investing in value stocks is long-standing. Paying a lower price will give you higher expected returns over time. History also tells us that after disappointing spells for low premium, this can lead to great opportunities. Consequently, from that point of view, we very much deem it appropriate to retain this premium within our portfolios. Next slide, please, Peter. Of course, we've talked a lot about stocks so far, equities, etc. However, very few people are going to be comfortable being fully exposed to the stock market. Consequently, we do look to include defensive holdings within our portfolios. Whilst we anticipate a moderate yield from these, the purpose is to dilute the risk. We do this by holding higher quality bonds, those with a low risk of default, short dated bonds, those that are without long before they actually mature, averaging on 4 to 6 years, in order to provide the stability to that sector of your portfolio to offer that dilution against the volatility of the stock markets themselves. Recognizing that the yield is lower, we recognize that we do suggest that if you want greater returns, you just commit more to equities rather than trying to increase the risk of the fixed interest themselves. So moving on to construction, if you move on, Peter. What we look to do is bring these fundamental practices into our portfolios. We build in diversification. Now, first of all, whilst we do in our arsenal have portfolios that provide a greater reflection of global capitalization, and those that provide a level of access to ESG or environmentally and socially aware strategies, today I'm just going to focus on our most widely held portfolios, which reflect a UK bias. Firstly, we need to determine the equity to bond distribution, this being the foundation of the asset allocation decision. Again, we know we have a suite of 11 portfolios ranging from full bond exposure to full equity exposure, moving up in 10% steps. Today, I'm going to base the construction on portfolio 60, so named as it has a 60% growth or equity exposure in the portfolio. One of the other things to recognize, we've talked about diversification. Within this strategy, as of the end of March, and of course this will be a changing number, we've got over 31,000 different underlying holdings. Now, typically active fund managers may have in the region of 80 to 100. Imagine the greater level of protection and diversity that this level of diversity offers to you. And as Euripides was once known to say, there is safety in numbers. Next slide, please. The next, we look to introduce global exposure. What we've done, we've split this in a 2-to-1 proportions, with UK and the global commitment having equal levels of exposure, and the emerging markets having half that exposure to those larger markets, really to reflect the greater risk and reduced transparency of the emerging markets at this moment in time still. We also include a property within the structure, primarily because of its non-correlation with other asset classes, and this will amount to 10% of the growth holding. Just on the property fund side of things, you may well have heard some horror stories of suspensions of trading in property funds in recent times. We access property through unit trusts which buy and hold stocks which actually hold the property itself, rather than us holding the bricks and mortar. This maintains the level of liquidity that we want to retain within these portfolios. Next slide, please, Peter. And finally, we look to introduce these additional premiums that we've referred to earlier, the small and the value. We've built these in based upon the added returns that these have provided historically. And in this regard, under each global sector, we've split these in a 4-3-2 split: value highest, market second, small third. So the tilt to value being slightly higher than market, tilt to small being slightly lower than market itself. Furthermore, we also spread the bond holdings, taking into consideration duration, quality, and global exposure. And this has identified 3 optimum funds that meet all criteria. 2 of these funds have under 3-year durations, so we weight the distribution 70%, 30% towards those 2 holdings. And of those 2, we weight towards the global fund, recognizing its greater global diversity and its higher quality of stock. Overall, there we have a 4-3-3 distribution in that. And these proportions are reflected throughout the full range of our portfolios from 10 through to 90, obviously bond and equity ones having only bond or equity exposure. So that's the construction. If we can move to the next slide, please, Peter. Nick made reference to the fact that we need to plan in our portfolios. We need to determine what level of return is required to achieve our life objectives. Whilst the past is no guarantee of future performance, and that's particularly the case when considering active fund management, of course that's based upon reacting on a day-to-day basis based upon current events. When you invest across the whole markets in a buy and hold strategy, the traits of the past can provide a reasonable indication of what can be expected in the future. Again, stressing that this is when we're talking about medium to long-term timescales. Recognizing again that risk and reward are linked, what we have managed to identify are the levels of premium that are offered by being exposed to different sectors of the market. The chart demonstrates, for example, equity, being involved in committed into equities will give you a 3% return over that of risk-free treasury bills or low-risk bonds. Again, is identified in the past. What this enables us to do is to obtain an indication of medium to long-term growth for each of our portfolios based upon its exposure to each market sector. So, for example, if we apply portfolios distribution, which is shown in the end column, we apply that to the gross estimated rate of return to each of the underlying sectors. What we can calculate is that we would expect portfolio 60 to provide us with over 3.6% in excess of inflation as a return on those investments. So, for example, if we're assuming that inflation is in the region of 2%, we would expect an annual return over the medium to long term of over 5.5%, 5.6%. Of course, this is just an indication. We do regularly review it. And indeed, the timing of when you enter the markets, whilst we do not use timing as a tool, but the timing of entering the markets can impact upon that. Today being quite a prime opportunity to give an example of that, because if we enter the markets today, they're well down. And so we'd expect the impact of the recovery as well to increase the ongoing, the long-term return. Next slide, please, Peter. A busy slide, I know. Let me just explain this. Just as the past can give an indication of the upside that you could expect from a portfolio, it can also give a strong indication of what downside you could experience in the past based upon those that have been encountered in the past. This is a key part to determine the level of risk that an investor can tolerate in pursuit of long-term gains. So let me just quickly run through what this provides to us. On the left, we list our range of portfolios from bond up to portfolio 100, also quoting the FTSE All-Share as a benchmark against those. The next column provides what the annual return has been over the duration of the data that we've been able to extract. And then the third column takes into consideration the impact of inflation. So that really gives us the real return. Now, linking back to the building blocks I said in the previous slide, I said that the expectation we have for portfolio 60 going forward could be about 3.6% over inflation. This is because we've taken a very moderate view of the future. You'll see here from on portfolio 60 in the third column, historically, it has achieved 5.5% over inflation. The fourth column looks at the standard deviation. Without going into too great a level of detail, a standard deviation being a measure of risk. The higher the number, the greater the level of volatility experienced by that investment. But the key aspect of this is it tells us what experiences have been encountered by our range of portfolios over different timescales. So, for example, portfolio 60 again, we know that there was a time in history where over 1 year it experienced a 22% fall. And indeed, over 2 years, a 25% fall. Now, it may well be, going back to Nick's conversation about tolerance to risk emotionally and financially, if you feel, or if an investor feels that they are unable to be comfortable with taking a loss of greater than 20% at any one point, so I'd say taking a fall of greater than 20% at any one point, then perhaps portfolio 60 isn't for them. It might be more suitable to have a portfolio 50. As I say, these aren't losses, let me stress that. These are basically where the markets have fallen, from which they will always recover. And if we're looking at if you look at the right-hand side of the table, you'll see that even the worst case scenarios of our portfolios have given quite significant positive returns. Next slide, please, Peter. Okay, just really to finalize on the principles here, this is the side of where we look at the rebalancing, the discipline. From the moment you invested, a portfolio will start to drift from its target distribution, just generally because of different market activity. Rebalancing is a process used primarily for risk management to realign the underlying holdings back to the target allocation, suited to that risk profile of the investor. Whilst academics still debate the most effective way of doing this, we adopt a couple of alternatives. Either one, to consider the drift at the review meetings with our clients that we hold regularly and to make bespoke recommendations based upon our conversations there. Or secondly, to put in place tolerance limits, which if breached will automatically trigger a rebalance. As you'll see on the chart, there's an upper rebalance limit and a lower rebalance limit. If a group of our holdings, so the UK as a whole, the global world as a whole, or emerging markets as a whole, breach that tolerance, then a triggered rebalance would be brought into play. Now, at first sight, this might appear to be counterintuitive, selling out of something that's doing well and reinvesting in something that's performed less well relatively. However, if unattended, the portfolio will become increasingly overexposed to riskier asset classes, and that can leave the investor exposed to far greater falls than they originally were able to tolerate. Okay, Peter, thank you. Next, move on. So I'd just like to take a sort of a quick tour through the performance, initially historically, and then taking an overview of the impact of the COVID-19. Next slide, please, Peter. What we look at here, again, linking back to Portfolio 60, is demonstrating the performance of this disciplined strategy against accepted market benchmarks. Investment Association, the IA, the Investment Association, this representing about 250 fund managers, so including household names such as Fidelity, Invesco, Jupiter, very typically with active fund managers there. And the ARC Private Client Index, which looks at discretionary investment managers, such as houses like Coutts, UBS, Rathbones, Rothschilds, etc. Albeit that benchmark was only established in 2003. What we're demonstrating here is that the disciplined approach has enabled our portfolios to outperform the appropriate industry benchmark. Again, this is very much links back to the chart that Nick showed you earlier, erring away from coming out of and re-entering markets, which not only destroys wealth, but actually increases the level of costs from trading. The next slide will demonstrate that it is the same principle of Portfolio 80, just as an example to demonstrate there. And the next slide will demonstrate actually this tends to be reflected across our full range of portfolios. The exception to this being our bond portfolio, which is actually being measured against benchmarks that can have up to about 35% in stocks, in equities, whereas our bond ones retain all in bond holdings. So that demonstrates what's happened in forward. In bringing that to the current day, in the next slide, what's happened since COVID-19. As Nick mentioned, 20th of February, we saw markets fall. And of course, this demonstrates that there's a reversal of the pattern when the market experiences falls, with more highly market exposed portfolios experiencing the greater drops. However, other than the small period of time when banks drop their base rates, you can see that the bond portfolio, which is reflective of what the defensive element will be across all the portfolios with defensive holdings, it is doing its job of remaining stable, which in turn dilutes the impact of the market falls on all of the on all of the portfolios. Okay, next slide, please, Peter. Unfortunately, this is a little bit frustratingly, we're just again demonstrating the falls against the benchmarks we quoted earlier. Unfortunately, ARC gathers its data on a less frequent basis, but as you can see, it's a very similar trait as to the benchmark with seeing our falls there. You know, we would actually potentially expect slightly higher falls here, recognizing our tilts towards small and value that have seen some significant volatility. However, this isn't of great concern, because if we base things on historically, as demonstrated by the next slide, the 5 years following recessions, we have seen our portfolios rebound back in even slightly following or in outperforming those of the benchmarks. Unfortunately, for the benchmark going back for the .com one, the ARC data isn't available. But if we look in the next slide to the credit crunch position, as you can see, again, Portfolio 60 has outperformed both benchmarks in that recovery over those 5 years. Finally, in the next slide, returning to the current situation, when considering the performance across all underlying stock market funds within the strategy, you can see that they all follow very similar patterns, albeit the UK has experienced slightly deeper falls than other global regions. Much of this is due to the compounding impact of the uncertainty still surrounding Brexit, but also, as I'm sure you've heard in the news, OPEC talks ending, oil and gas stocks struggling with regards to that. The UK all share market consists of more than 10% in these sectors. So this will have a high impact upon us as well. Furthermore, we've seen investors with a flight to the perceived safety of large stocks, which of these have a slightly lower exposure in the UK than they have in the likes of America, for example, which might again influence slightly different performance in that regard. So ultimately, I suppose in wind up, we recognise that small and value has been typically more greatly affected than just the general markets themselves. However, again, calling back to history, we have seen that these all have rebounded very strongly from a recovery, giving us another reason why we would not be looking to move away from a value tilt. Thank you very much. Let me now take you back to Nick.
Thank you, Paul. A bit of a whistle-stop tour for all of that. Some fairly complex subject matters covered there. So apologies, we are running a little bit behind, and we'll go over the expected timescales. If we could move on to the next slide, please, Pete, and the next one, please. So I'm going to now look at some predictions on the markets. As many of you will know, we don't like making predictions because it's a very difficult task to try and do that, but we'll give it our best go. I did hesitate whether to include this in the webinar for that reasons, but the reality is I do not know how this global pandemic is going to end or the exact impact it's going to have on the global markets. But I am confident about one thing. In the future, UK and global stock markets will be higher than they are today, and Portfolio Sense is perfectly positioned to capture these returns, as we've seen in previous market downturns where Portfolio Sense does tend to bounce back a little bit quicker. So there you have it. That's my prediction. Global markets will be higher in the future, but we all knew that, didn't we? So let's look at some of the scenarios of this inevitable recovery. And what you can see on this slide here is the various, I suppose, scenarios where we will see the markets recover. The bulls out there, the bullish optimists, hope to see a V-shaped recovery. So that's the orange line on the screen there. This will see markets recover to their previous highs within 6 months. For this to happen, we really need to see the dire effects of COVID-19 disappear fairly quickly, for business to embrace the new normal and profit from it, and for the rapid discovery and distribution of a vaccine or a cure before the end of the year, whilst of course avoiding a second wave of COVID-19 and the resultant shutdown again of the global economy, plus of course the avoidance of a Cold War between America and China. So the bulls take all that into consideration, but most expect this U-shaped recovery, the blue line there on the graph, like we witnessed in 2009, sort of, where it will take 6 to 18 months for the markets to recover to previous highs. With the economic devastation caused by COVID-19 lingering, corporate earnings hit and profits disappearing, while social distancing still impacting on regular business activities, again, until a vaccine and cure is available, maybe into 2021. So the majority of forecasters will probably be looking at a U-shaped kind of recovery. The bears, in contrast, are looking at an L-shaped recovery, or some have described it the Nike tick recovery. This is where it will take up to 18 months for the markets to recover, with the virus lingering, resulting in unprecedented economic damage, maybe geopolitical tensions with the West and China, plus other conflicts stirring, adding to the uncertainty. What's not on that table there is a less spoken about W-shaped recovery. This is where we've seen a big drop in markets. It's been fairly rapidly followed by a mini recovery, and that might be followed by another drop to the previous floor that we've experienced, followed by another quick recovery. We can expect probably a W-shaped recovery perhaps when the impact on corporate earnings becomes a bit more transparent over the next few weeks and months. Maybe COVID-19 death rates persisting, and there had been a second spike in infections and lockdowns to get further batter the global economies, impacting on corporate earnings. So, the one consistent theme here, and let's take the positives from this, is everyone agrees that the markets are going to recover. They just don't know when it's going to happen or if we've hit the floor yet in terms of market prices. But, you know, our prediction is markets are going to go up. If we look at the next slide, please, Peter. Again, if you take a look at, again, we're looking at Paul's portfolio 60 here. And again, it looks at, you know, from every market crash apart from in August 1989, in the next year after that crash, we see positive investment returns, healthy returns over 3 years, in which the lowest return being plus 12%, and positive returns over 5 years, ranging from 42% to 81%. Of course, this is portfolio 60. If we had 100% equity funds, the returns would have been even higher. So whilst past performance, of course, is no guide to the future, it's a good mirror. And I personally take comfort from this fact, and so should you. Stock markets have bounced back in the future, and they will bounce back from this as well. If we look at the next slide, one prediction I'm pretty confident about is that there will be a recession, sadly. You know, before we consider the impact on the markets of recessions, let's just look at how recessions pan out. And there's 3 stages to these recessions. Stage 1 is going into the recession. This is the most certain recession we've ever seen. I think you'll all agree. We can all observe the dramatic fall in daily activity around us. Discretionary spending has been curtailed, and most expensive discretionary spend are holidays. Tourism has been hit the most. And this isn't a slow evolution where individuals gradually discover, like most recessions, a new economic reality. We've been instructed to stop consuming. So this instruction is worldwide as well and instantaneous, something that's never happened before. And this recessions are normally V or U-shaped. The first leg of this recession will resemble the U-shaped form. It will be vertical and dramatic and probably see the largest collapse in GDP on a weekly and monthly basis in many countries ever witnessed. The second stage is the end of the recession. And given the recession's speed and depth due to the virus and resultant government action to prevent us from mingling together, we have an unusually strong idea when this recession ends, and this is when we all get back out there and hopefully start getting back to some kind of new normal. So at some point, hopefully in a few months, the government policy will change and we return to a normal kind of behaviour, and this bounce back will be enormous. So the population is no longer staying home, thus economic data will rebound. And it won't be a V or a U, it'll be more like an I-shaped. So again, we'll probably witness the biggest ever jump in GDP on a weekly or monthly basis in many countries. And then stage 3 after the recession, the dramatic collapse and recovery will cause some longer term damage to the economic system, no doubt. Firstly, from an overall business and personal confidence level, and secondly, due to the unprecedented nature of the severe short-term pain on recession. Human behaviour is likely to change, and vulnerable companies relying on short-term discretionary spending will have been weakened. Give you an example, you know, buying a car, that will be deferred, but going to the cinema, that money's been lost by the companies. So on the positive side, unlike many other recessions, developed economies exhibit low unemployment, and considerable numbers of the population will remain employed by historical standards, and many businesses will remain stable. And hopefully the fiscal support will help those who are struggling a bit more. So therefore, we hope the post-recession growth will return to normal, but initially be unlikely to be at the previous levels. This makes the type of recession a capital T-shaped, a sharp pull down, a sharp rebound, and then back to normal economic cycle. At probably a lower level than before, unless the policy response from governments overwhelms the downturns, in which case we could get back to where we were. We look at the next slide, which shows you how stock markets perform in recessions. So again, as you'd expect, as we witness today, as we enter recessions, markets have fallen quite dramatically. And during the turn of the century recession, we witnessed a very healthy recovery, particularly in emerging markets. So we're about to emerge at this point. And if we look at the next slide, again, this shows you following the credit crunch. Again, we equally witnessed good initial stock market recovery after the recession, and a very long bull run that came to a dramatic end in February this year. So the conclusions we can draw from this is that before and during the recession, markets will fall and remain volatile. But when we see the green shoots of recovery, markets tend to react positively. The final slide I want to look at is, again, the slide that Paul looked at earlier, and the question here is, well, what should we do with our holdings? So you can see, obviously, UK has been more severely hit than the global market, as for reasons Paul explained earlier. But it goes without saying, the last thing you should do at the moment is sell. This would be the worst possible thing you could do, knowing that in time the markets will recover. If you need access to funds, then selling bonds would be more appropriate if you have bonds within your portfolio, given that these have held their value. So you should sit on your hands and wait for the markets to recover. For most people, this is probably the best thing you can do, to ride out the storm and enjoy the recovery in values that's going to happen in time. There are some who may want to consider an opportunistic rebalance, selling some bonds maybe and buying some equities today. This will, of course, accelerate short-term losses if we have this W effect in the markets, when the market's going to reverse again. But if you're taking a medium to long-term view, which you have to, and have both the financial and emotional capacity to cope with any short-term downside, then this could very well be profitable. And the same can be said for cash. If you're sitting on cash and you don't require it for some time, again, these are good times to invest. And while not for the faint-hearted, investors today should be rewarded in the future. As they say, fortune favours the brave. Of course, anyone considering all these options does need to take individual advice. Next slide, please, Peter. Okay, so we've come to the end. Again, apologies for going a few minutes over. I can see there's a few questions here. If Paul could come back in now, please. If you do want any other questions, please use the Q&A just on the Zoom bottom tab there. There's a Q&A in there. So there's a couple of questions that have come in. One from Mike Harper, and it asks, when talking about long-term risk, what do you mean by long-term? How many years? I think I touched on this in my part of the webinar. In reality, Mike, we take long-term as 10 plus years, but in reality, we do see this as probably life. Whilst we hope our clients will knock on our door and say, hey, can we have some money out, please, because we want to spend it, we're not taking it all out. So ultimately, we are looking at a lifetime of investing, but certainly a minimum of 10 years is typically what we're looking for. Because as we mentioned earlier, you know, for investors, time is the biggest ally. The second question from David. Hello, David. How would you rate online investment tools such as Nutmeg? You know, their problems have been well known, David, in the press in terms of financing. Their platform seems efficient enough as an investment tool. But ultimately, it's what funds you choose to invest in or stocks and shares you choose to invest in within Nutmeg itself. So it's not Nutmeg that will give you the returns. It's really the investments that you select that are held within that Nutmeg platform. So, you know, I have no real, I suppose, opinions one way or the other over Nutmeg. They're a platform that give you access to investments, and it's the investments that will drive the returns, and that's most important. We've had another question come in from Chris. Hello, Chris. Paul, I'm going to hand this one over to you if you don't mind. Delayed Brexit, effect built into this. So do we think a delayed Brexit has been built into the prices, current prices? I think what you mean there, Chris?
That's a fair question. I mean, all I'd return to on this regard is that basically today's price of stocks reflects everything that's perceived to be known or is known about the economy, about the underlying stock itself, etc. So by the very nature of that, we would anticipate that any sort of ultimate impact upon Brexit has got some sort of pricing already included in the cost of stocks. Obviously, what we don't know is what actually happens in the future. And you know, these stock prices will change on a daily basis depending upon individual investors or fund managers' perceptions of that. But as of today's price, it will reflect what the market believes will be the route forward.
Thank you, Paul. Bill, hello, Bill. Quite a strong message on risk and reward. How would you advise on a client currently on portfolio 55, which will be obsolete, thinking of jumping to 60 or 70? I'll take that one, Paul, if you can look at the next question. Yeah, again, it's all down to risk capacity and emotional tolerance for risk. Taking a medium to long-term view, provided investors can accept short-term volatility and short-term losses, moving to 60 or 70 will generate rewards over an 18-month plus period. And obviously, we can look at rebalancing downwards when the markets have recovered. So, our view is that markets will recover. And if we take history as an example, in the last recessions, they recover typically over 2 or 3 years. 3 years would probably be a worst case scenario. And it would be fairly unprecedented if it takes 3 years for the markets to recover. So I'd have no issues with jumping to 60 or 70, provided the investor can emotionally tolerate that level of risk and financially accept further hits on the short-term value of the portfolio. Next question, Paul, is logic will say corporate earnings will drop, so the market will also. Surely the time to buy is not now, but over the next 6 months.
Yeah, very, very interesting question. What we don't look to do is try and time markets. Again, that is down to a perception that this may occur, this may not occur. What we actually do know, however, is that the price of stocks now is significantly below the level that it was mid-February at those points in time. So even if we do experience further drops from buying, if we did buy now and experience future drops before the rises occur, we are still obtaining value compared with where we were at the market peaks literally only about 6, 7, 8 weeks ago. Going back to Nick's greed and fear curve, another one of the emotions in there is sort of expectation, the anticipation of things happening, which can often lead us to actually missing out on opportunity, because by the time we act, markets have done something differently from what we'd hoped or anticipated. So even buying now, you will be getting a good premium compared with where you were only 8 weeks ago.
Absolutely, and I'd concur with that. And as I said, it is a brave person that invests today, but as we said earlier, fortune favours the brave, and trying to time the bottom of the market is a mug's game, really. We can reduce the risk slightly by phasing investments in, of course, and many people will want to do that, but trying to pick the bottom penny is very difficult. David Palmer, hello David. What's your best guess on interest rates? It's all very well having cash reserves, but where do you put it to get some return? Yeah, great question, Dave. I think guess on interest rates, well, they can't go much lower other than going into negative territory, of course. And I think the monetary policy will really be dictated by how inflation reacts to this COVID-19 over the coming weeks and months. We can still get in cash reserves 1 to 1.25%, but equally it is fairly dire at the moment, Dave. But I don't think we're looking for return on cash. The only amount really we should have in cash is what's there to cover short-term expenditure over the next 2 to 3 to 4 years. So we wouldn't recommend excess cash unless it's going to be spent to cover income shortfalls or a spend project in the next few years. So if you can tolerate risk, then maybe the time is to be putting it into markets within portfolios that are more suitable for you. I think Martin, hello Martin, how great do you think the impact of a crash out of Brexit will be relative to a global recovery? I think, and as Martin mentioned, I think we've answered that one, Paul. Is there anything you'd add to that?
I don't think so. Again, it goes back to the element of speculation rather than investment. One of the things we do focus on is what we can control rather than what's outside of our control. So whilst it sounds a little bit dismissive, it's not meant to be. It's we can't influence the output. We can only take control of what goes in effect.
Yeah. John, I'm going to come back to your question at the end if I may, but question here from Peter. Hello, Peter. Given the severity of the current situation on the profits of so many companies at the moment, do you feel that the market is currently defying gravity? Great question, Peter. I'd expect nothing less from yourself. Don't know. I think you would like to think that the stock markets and investors are aware that corporate profits are going to be hit massively, and this is already reflected in their price. The reality of this situation will be seen over the coming months when corporate companies will be announcing their earnings. And yes, we could see gyrations in the markets and individual share price falling as they do. And this is very much part of this W model and recovery. So yes, that the reality of the severity of the situation could cause a downturn in the markets, Peter, but equally, the markets are strange things. When these corporates do announce their profits, the investors may think, oh, it's not as bad as we expected, and the share price may actually increase. We just don't know. The markets, though, what I would say, and you may agree with this, Paul, I hope you do anyway, is the markets are pretty efficient, and they do price all of this in. Is there anything you'd add to that, Paul?
No, I think you've actually you've said it all. There is the efficiency in the markets. We don't try and anticipate what will happen in the future, and of course, I don't think there will be some winners in all of this as well. There are definitely companies out there that will thrive from coming out of this. They will have set themselves up in a good position during the downtime that they may have had, and can actually go on to stronger things. So. Yeah. I think it's going to be a mixed situation. Linking what Nick said there, it wouldn't surprise me if there is a bit of a W impact on these side of things. But hopefully, with the sort of the government support that's helped retain some businesses without having to lay off as many as they might have, will come to the fore and help the recovery at that point.
Yes. A question we had before the seminar from Martin. Hello, Martin. And his question was, again, I think we have probably covered this, but a question was, if you have cash, should you ride out this coronavirus storm, or would you wait until the turbulence goes and the risks of volatility, given it's high at present? So would you sit it out, or would you get back into the market as soon as possible so you're not missing out on the rebound? Paul, do you want to make a few comments on that?
No, that's again an excellent question. I think recognising it depends really on the purpose of the cash that you've got. If that's not something you're going to be calling upon for some years yet, then I would strongly suggest that you get those into the markets. Linking back to the question earlier about whether to get in now, whether to get in 6 months. Well, we know where we are today. We don't know where we're going to be in 6 months. Today is giving you a discount on where we were 8 weeks ago. However, if some of that cash is something you may need to rely upon over the shorter term, so let's say the next 3 to 5 years, then perhaps retain those to one side and just look at investing the excess at this point that, as I say, you can afford never to or not to touch for a number of years yet.
I think it's always dangerous at times like this as well to be out of the markets. If cash is there to be invested long term, then again, taking Paul's view, I would probably be consideration of a drip into the markets over the next few months. Certainly would be my view. But again, in these kind of instances, individual advice needs to be taken. Right, I think I'm going to come back to a question from John now. It's slightly non-investment related. There is talk of a wealth tax in the papers. Any views? Thank you, John. Good. Hello there. Yes, John, I think there's no doubt about it. There is lots of speculation, and it is speculation at the moment, of how the government's going to pay back this massive, is it 180 billion pounds of debt that it's raising at the moment on bonds. It will have to be paid back, and it probably will be paid back by higher taxes. How that is distributed remains to be seen, but I think we will probably see a rise in progressive taxes. So those that earn more will pay more tax, and those that have more may pay more tax. And there are some easy targets the government can potentially look at. They may also look at removing some of their expenditure. For example, easy targets would be increasing the state retirement age, removing higher rate tax relief on pensions, and other relief associated with investments. So it's all speculation at the moment, but I think we are in a situation where the government will have to raise more tax, but equally it doesn't want to stifle entrepreneurship and those people that get out there and invest money and create jobs, because those are the people that are obviously funding a lot of this enhanced expenditure as well. So it's a real balance that the government needs to show over the next few months and years, but we shall see. Okay, that brings us to the end. There's no more questions. So again, apologies for going over the allotted time. I'd like to thank you all for joining us this afternoon. And of course, we will be sending a copy of this webinar, the video of the webinar, onto you. It should be with you by Monday. I'm not sure if you want to watch it again, but of course you can. It's there as a resource for you, or indeed you can send on to others who may have not been able to make today's session. So thank you very much. We've enjoyed doing this today. Thank you, Paul. Thank you, Peter, for your help with today's webinar. And I hope you all stay safe, and I look forward to seeing you all face to face in the not too distant future. Many thanks.